Good morning and welcome to Esquire Group's presentation on FIRPTA, what you need to know. First, we're going to start off with a brief disclaimer. This presentation is for informational purposes only. It was prepared for educational purposes. It is not to be considered legal or tax advice, nor is it to be construed as such. Each individual's circumstances are different. You should seek legal and/or tax advice to address any specific questions you may have. Furthermore, this is a general overview of FIRPTA and its most common applications. It's by no means a complete education course on all aspects of FIRPTA. Before we get started, I'll give a little bit of background about myself. My name is Sexton. I have a bachelor's in business administration, a JD, and an LL.M in international taxation. I'm the president of Esquire Group. We're an international tax advisory firm with offices in Las Vegas, Phoenix, Vienna, Austria, Frankfurt, Germany, and the United Arab Emirates. My specialty, as well as Esquire Group's, is international taxation, including tax issues facing U.S. citizens and resident aliens living abroad, expatriation, investing or doing business abroad, as well as foreign investment in the U.S. I'm fluent in both English and German. Before we jump into FIRPTA, in your GoToWebinar application, you do have the ability to type in and ask questions, which I'll answer or do my best to answer most of them at the end of the presentation. So to start off, I'm going to give a little bit of background about FIRPTA, why it exists, and how it works. So essentially, if a foreign person invests in the United States in U.S. real property, so U.S. real estate, they have to pay tax on any gains that they realize from the disposition of those U.S. real property interests. And we'll get into the definition of U.S. real property interest a little bit later, because it goes beyond simply just owning actual real estate. So a foreign person that disposes of a U.S. real property interest is required to file a U.S. tax return to report the sale of that U.S. real property interest and pay the tax on any gain that they realized in selling or disposing of that real property interest. And the reason that Congress enacted FIRPTA, or the Foreign Investment in Real Property Tax Act, is to guarantee the payment of tax. So before FIRPTA, a foreign person could come to the United States, purchase real estate, sell that real estate, realize the gain, and then just leave the United States without having paid the tax on that gain. And the U.S. didn't really have any recourse against that foreign person because they took their money and left the United States. So FIRPTA requires tax to be withheld on the amount realized by a foreign person from the disposition of a U.S. real property interest. And in the most simple terms and in the most common application, this means when a foreign person sells U.S. real estate, there has to be withholding on the sale price and tax paid to the IRS out of the sales proceeds before the foreign person ever even has to file a tax return to report the gain. This way, the United States has received some portion of tax. And we'll get into details of how all of this works a little bit later on. But generally speaking, that's how it works. And if you look at this last point that I made here, where it's written that FIRPTA requires tax to be withheld on the amount realized by a foreign person from the disposition of a U.S. real property interest, you'll notice that I highlighted certain words or phrases. And the reason being is I think it's very important to define these words and phrases so that they can be taken in the context of FIRPTA. And so I highlighted the terms that we're going to be defining in the next few slides. They're not defined in the order presented in this sentence, but I think that they are presented in a logical order that will make sense. So the first question is, who does FIRPTA apply to? So FIRPTA applies to foreign persons disposing of a U.S. real property interest. So first, let's define who a foreign person is. So a foreign person is first and foremost a non-resident alien individual. So a non-resident alien individual is somebody who is not a United States citizen, somebody who does not have a green card, and somebody who is not considered a U.S. resident for tax purposes. It is also a foreign corporation that has not made an election to be treated as a domestic corporation, a foreign partnership, a foreign trust, or a foreign estate. And you'll notice at the end here I have a note. It says a resident alien individual is not a foreign person. So a resident alien is somebody that has a green card or somebody that is otherwise resident in the U.S. For income tax purposes. And the way that happens is that somebody meets something called the substantial presence test, which means that by virtue of spending a certain amount of time in the U.S., that they've become tax resident in the U.S. without being a citizen or a green card. So now that we know who a foreign person is, let's talk about what a disposition is. Because a lot of people think FIRPTA only applies to sales. But if you go back to the sentence on the earlier slide that I had, it applies to dispositions of U.S. real property interests by foreign persons. So a disposition is not only a sale, but it can also be a gift or a redemption in the case of a corporation. So for example, if a corporation was a U.S. real property holding corporation, and we'll get into what that is a little bit later, and there was a stock redemption, FIRPTA could apply to that. FIRPTA also applies to capital contributions. So for example, if a foreign person owned U.S. real estate and wanted to contribute that foreign real estate to a corporation, that would be considered a capital contribution. FIRPTA would apply. And then there's the catch-all of any other transfers. So basically, if a foreign person owns U.S. real estate and that U.S. real property interest is being transferred out of that foreign person's name, FIRPTA is most likely going to apply. There's a few exceptions, and we'll get into what those are later. But in most cases, FIRPTA is going to apply to any transfer of real estate from a foreign person to somebody else. And when I say somebody else, that includes some business entities. So now let's talk about what a U.S. real property interest is, because a lot of people are confused by this. And a U.S. real property interest goes beyond just U.S. real estate. U.S. real estate is obviously the most common type of U.S. real property interest, but it is not the only type of a U.S. real property interest. So another U.S. real property interest is certain property associated with the use of the real property. So take, for example, a farm. If there's certain farm machinery that's installed on that land that's associated with the use of that farm, that could also be considered a U.S. real property interest. And then there's something that I had mentioned earlier, which is a U.S. real property holding corporation. A U.S. real property holding corporation, most simply stated, is a U.S. corporation where the majority of the assets consist of U.S. real property interest. So more specifically defined, it's a U.S. corporation whose U.S. real property interest equals or exceeds 50% of the sum of the fair market value of its U.S. real estate, real property outside the U.S., and certain business property. So for example, if you had a corporation and its only asset is U.S. real property interest, so you have a U.S. corporation and all it does is own a piece of land, it's going to be a U.S. real property holding corporation. Or if you have a U.S. corporation that owns another U.S. corporation, and that second U.S. corporation owns nothing but land, and the stock of the second corporation is the only asset of the first corporation, the first corporation would also be a U.S. real property holding corporation, because the shares in the second corporation would be considered a U.S. real property interest. So I think it's just important to note that that FIRPTA could also apply to the shares of a U.S. real property holding corporation. So if someone, let's say a foreign person, owned shares in a U.S. company, and all it did was own, let's say, an apartment building, and that foreign person wanted to sell the shares of that U.S. company, FIRPTA would apply to the sales of those shares just as it would to the sale of real estate by a foreign person. So I think that's just the important thing to note, that FIRPTA can also apply to the sales of shares of a U.S. real property holding corporation. It's not just real estate itself. And if you recall back to the first sentence or the earlier sentence with some of the highlighted terms, the withholding is based on the amount realized in the disposition of the real estate. So the amount realized is basically the cash paid or to be paid. So in the very simplest form, a foreign person is selling a U.S. real property interest. They're getting cash in return for the sale. The cash paid or to be paid is the sales price. Also, the fair market value of other property transferred or to be transferred can also be considered the amount realized. So an example would be, let's say a foreign person owned a house and they were trading that house for a Bentley. Whatever the value is on that transaction, the Bentley is essentially the same as money and would be considered amount realized. Also, if the amount realized can also include a liability. So let's say, for example, you had a foreign person that owned a piece of property worth $200,000, and there was a loan on that property that was $200,000, so there's essentially no equity, and somebody agreed to take over that loan. Because the person is being relieved, because the foreign person is being relieved of a debt, that's the amount realized, because somebody else is now going to be responsible for that. So now let's talk about the withholding. So going back to the earlier sentence, FIRPTA applies when a foreign person applies to the amount realized when a foreign person disposes of a U.S. real property interest. So now we've talked about what a foreign person is, we've talked about what a disposition is, we've talked about what a U.S. real property interest is, and we've talked about what the amount realized is. So now let's talk about what the withholding is. So the withholding is 15% of the amount realized by a foreign person who disposes of a U.S. real property interest. So for example, consider a foreign person sells a house for $500,000. They've disposed of a U.S. real property interest for $500,000. The withholding would be $75,000, so 15% of $500,000. There is a special rule where there is a reduced 10% withholding rate if the transferee, and the transferee in this example would be the person purchasing the U.S. real property interest. So the reduced rate applies if the purchaser or the person receiving the U.S. real property interest is acquiring a personal residence and the purchase price does not exceed $1 million. Then you have this reduced rate of withholding of 10%. And 10% up until the end of last year, 10% was actually an across-the-board withholding rate. Under the PATH Act that was enacted in December of 2015, the withholding was increased from 10 to 15%. So that's a relatively new change. Now, what's interesting about the withholding is that the transferee meaning the recipient, is considered the withholding agent, and they're the one that's required to withhold and pay the tax to the IRS. So going back to the example of a foreign person selling a property for $500,000, the $75,000 of withholding is required to be withheld by the buyer. The buyer is the transferee in this situation. So it's the buyer's responsibility to make sure that that $75,000 is withheld. So the way the transaction would work is when the buyer pays the $500,000 for the property, they would give $425,000 to the foreign person that was the seller, and they would give $75,000 to the IRS. Now, the withholding agent is responsible for not only the tax, but can also be responsible for interest and penalties if they fail to withhold and pay the tax to the IRS. So in this case, if the buyer purchased a property from a foreign person and failed to withhold that $75,000 in withholding tax, the IRS is not going to go after the foreign person that sold the property, because that's going to be pretty difficult. The person might be in a foreign country, and the IRS might not have the ability to go after them. So the IRS is going to go after the person that's more likely in the U.S., the buyer, and try to collect the tax, interest, and penalties from them. One of the things that I think is important to note is if you're the buyer in this situation and you knew you were supposed to withhold and you didn't do it, then that's willful conduct and can be subject to a $10,000 penalty. One of the things that I think is really important to note when it comes to FIRPTA is it's not always clear if the person selling the property or disposing of the U.S. real property interest is a foreign person or not. What happens if the person disposing of the U.S. real property interest is an entity and is a U.S. entity? For example, a U.S. trust or partnership, an LLC or domestic corporation. Generally speaking, a U.S. trust or partnership, there's generally no FIRPTA withholding requirement by the transferee. So in the examples we've been using by the buyer, the withholding would be required by the partnership itself. So if we go back to the example that I was giving earlier, you have a foreign person that sells to a U.S. person for $500,000. Let's change this example a little bit, where we have a U.S. partnership that is owned by two foreign persons, and that partnership sells the property to a U.S. buyer for $500,000. The U.S. buyer is not required to withhold the FIRPTA withholding when they pay the partnership. So rather than paying $425,000 to the foreign person and $75,000 to the IRS, they would pay the full $500,000 to the partnership, and the partnership would be required to do the FIRPTA withholding and pay the IRS on behalf of the two foreign partners. So that's a little bit different, because in that instance, you still have 100% foreign ownership, but because it's through a U.S. partnership, there would be the buyer would not be required to do the withholding. Where things get a little bit trickier, and this is quite common, is when you look at LLCs. Just because somebody has a U.S. LLC does not mean that the transaction is exempt from FIRPTA. A single member LLC in the United States, by default, is disregarded for U.S. income tax purposes. That means it's tax transparent and it's as if it did not exist. So one of the issues is what happens if you have a foreign person that owns, let's say, a Nevada LLC that owns a piece of property. You have to find out who's behind the LLC. You have to find out, is it one owner, is it two owners? And if it's one owner, then you have to find out if that is a foreign person or not. Because if it is a foreign person, then that transaction is going to be subject to FIRPTA withholding, and the buyer is going to be required to withhold the FIRPTA tax. If it's a single member LLC that's taxed as a U.S. corporation, then there would be no FIRPTA withholding. So it's just single member LLCs that are taxed as disregarded entities. If it is a multi-member LLC, generally those are taxed as partnerships, and the same rule applies as a domestic trust or partnership. So basically, the transferee or the buyer would not be required to withhold, and the LLC itself would be required to handle the FIRPTA withholding. A domestic corporation, the buyer would not be, the transferee or buyer would not be required to withhold. One thing to note is even though the transferee, the recipient, the buyer, may not have a FIRPTA withholding obligation, the trust, partnership, or corporation may have a FIRPTA withholding obligation on any distributions or dividends paid to the foreign person or persons owning that U.S. entity. Now, there are a few exceptions to FIRPTA where you can avoid the withholding that's required under FIRPTA. One of the most common that is used is if the property is acquired for use as a resident and the purchase price is not more than $300,000, and the person purchasing that property or a member of their family has definite plans to reside in the property for at least 50% of the number of days the property is used by any person during each of the first two 12-month periods following the transfer, then it would be exempt. And you can't count the days that are vacant. So essentially the way this works is if the property being sold is being sold to somebody who is intending to use the property as a residence, either them or a member of their family, the sales price is not more than $300,000, and they intend to use that property as a residence for more than 50% of the time of all the days that it'll be used over the next 2 years, then this would be exempt from FIRPTA. And this is pretty easy. The buyer just has to sign a statement essentially saying that them or a member of their family intends to use the property as a residence for more than 50% of the time over the next two years. The other exception is that the seller certifies that they are not a foreign person. So, for example, let's say you had somebody who was a Canadian, but they were a U.S. tax resident for whatever reason. Let's say they met the substantial presence test because they spent a lot of time here, and they signed a statement saying that they were not a foreign person for FIRPTA purposes. Then it would also not be subject to the withholding. Finally, we have something called the withholding certificate. And this is where the property, for example, if the property is being sold at a loss, or if the actual tax is going to be less than the FIRPTA withholding, or a transfer to a business entity. And I'll give some examples of how the withholding certificates work when I get into the example in I believe it's the next slide. Also, if it's publicly traded stock of a U.S. real property holding corporation, then that wouldn't be subject to FIRPTA or disposition of a publicly traded partnership interest. If it's a non-recognition transaction, so for example, we have like-kind 1031 exchanges, those wouldn't be subject to FIRPTA. Or if the property is purchased by the U.S. or a state or a political subdivision, then FIRPTA would also not apply. So I want to get into a very simple example of how FIRPTA normally works, and then I'll modify this example a little bit to show how some of the exceptions can apply in this particular circumstance. So let's assume for a second that Joe's a citizen and resident of Canada, and for purposes of FIRPTA, he's a foreign person. Joe purchased a house in Phoenix, Arizona in 2012 for $200,000. Joe decides to sell the house to Fred in 2016 for $450,000. In this case, Fred is the transferee. He's the buyer, the person receiving the property. And he's required to withhold 10% of the purchase price and pay it to the IRS pursuant to FIRPTA. Now, if you remember, the normal FIRPTA withholding rate is 15%. But because this is a residence and because the sale's for less than $1 million, we get the reduced FIRPTA withholding of 10%. So in this instance, the $450,000 that Fred is going to pay for the property is broken up by paying $405,000 to Joe and FIRPTA withholding of $45,000 to the IRS. So now Joe has to file his 2016 tax return to report the sale of the property. Now, he paid $200,000 for the property. He's selling it for $450,000. We have a gain of $250,000. So he would report that $250,000 as a gain on his tax return, and he would also report that he's paid $45,000 in tax because, and that $45,000 is the FIRPTA withholding that was paid by Fred on Joe's behalf. Now, because Joe's gain is long-term capital gain, he owned the property for more than a year, he's only going to be taxed at a rate of 20%, which equals tax of $50,000. Joe only had $45,000 in FIRPTA withholding, so he would owe an additional $5,000 in U.S. income taxes. Now, you could also switch this example around, and let's say, for example, that Joe were to sell the house in 2016 for $350,000. Well, in that instance, you would only have $35,000 of FIRPTA withholding paid by Fred on Joe's behalf to the IRS. So the gain on that transaction would be $150,000. He paid $200,000, he sold it for $350,000. You have a gain of $150,000. There's 20% tax on that, so the gain is $30,000. There was $35,000 of FIRPTA withholding. So when Joe files his tax return, he's going to receive a refund of $5,000. So now let's change this example up even a little bit more. Let's say, for example, Joe purchased this house for $200,000. And he sold it, or he's selling it, for $150,000. Well, I'm going to backtrack here to the former slide. Let's apply the first exception. If Joe's selling the property for $150,000, we're under the $300,000 exception amount. So if the person buying the property is planning on using it as a residence for more than 50% of the time for the next 2 years, then the property is going to be exempt from FIRPTA, and there's not going to be any withholding. The buyer's not going to have to withhold 10% of the $150,000 and pay that to the IRS because they meet this first exception. Now, there's also another exception that could apply here, and this is where we get into the withholding certificates. Let's say, for example, that the person purchasing it was planning on using it as a rental property rather than a personal residence. Well, in that instance, this first exception wouldn't apply. So because they would be using it as a rental property, and the first exception doesn't apply, technically there should be $15,000 withholding by the buyer on the $150,000 sale price, and that $15,000 paid to the IRS, and $135,000 of the purchase price paid to Joe. But Joe has the option of applying to the IRS for what's known as a withholding certificate. And essentially what Joe does is he goes to the IRS and makes an application and says, "Dear IRS, I paid $200,000 for this property. I'm selling it for $150,000. I have a $50,000 loss." The IRS would then issue a withholding certificate saying, because there's not going to be any tax due, because the property is being sold at a loss, there's no FIRPTA withholding required on this transaction. And Joe would then give this certificate to Fred, and then Fred would know that he doesn't have to withhold any tax. The same thing applies if the actual tax is going to be less than what the FIRPTA withholding would be. So if you go back to the example where I was talking earlier about Joe bought the house for $200,000 and sold it for $350,000. If you remember in that example, Joe would have gotten a $5,000 refund when he filed his U.S. income tax return. Joe could have also, in advance, applied to the IRS for a withholding certificate and said, "Hey, dear IRS, my tax is only going to be $30,000 and not $35,000. Will you please issue a withholding certificate telling Fred to only withhold $30,000. And the IRS would then issue a withholding certificate saying only $30,000 of withholding was required. And Joe would give that to Fred, and only the $30,000 would be withheld. The other, another common reason to get a withholding certificate is a transfer to a business entity. So, for example, you have a foreign person. Let's say Joe has this property that he paid $200,000 for. It's now worth $450,000, and he's transferring it to a U.S. corporation as a capital contribution to that company. The U.S. corporation should be doing withholding under FIRPTA. You can apply for a withholding certificate in that instance, asking the IRS to not subject it to FIRPTA because there's going to be a non-recognition of gain. I think those are some of the most common applications of withholding certificates. I think that pretty much wraps up this presentation about FIRPTA and how it works in its most common applications. I hope you found it helpful and informational. If there's any questions, I'll go ahead and try to answer those at this time. So I have, first question is, when does the 35% withholding apply? The 35% withholding applies on certain dividends that are paid to foreign persons from corporations. So that's not actually a withholding on a normal sale. That's an application to dividends. The next question is, does FIRPTA apply to a foreign person who has a tax ID number? Meaning, does he need to pay the tax due up front? A tax ID number is not proof of being a U.S. person. A tax ID number is simply that. It's a tax ID number. So just because somebody could have a tax ID number for many reasons. I mean, let's say, for example, you had a Canadian that owned a rental property in Arizona, and the property, they were receiving rental income, so they needed to file a U.S. income tax return. They would have a tax ID number in order to be able to file their U.S. tax returns, but they're still a foreign person for FIRPTA purposes, and would be and FIRPTA would apply. So just the fact that somebody has a tax ID number has no bearing on whether or not FIRPTA is going to apply to a transaction that they're involved in. All right. Well, I think I've answered all the questions that have been asked. So I'm going to go ahead and end this webinar at this time. Again, I hope that you've enjoyed it and found it informational. And I wish you all a good day.